everyone, and thank you for listening to this April 19 Economic Impact video with our well-known economist, Stéfane Marion. Hello, Stéfane.
Morning, Martin.
So we're not starting with the pandemic. We need to start with the talk of the town, which is inflation. Stéfane, what's going on?
That's still a line that trends up, Martin, and you can see that from a U.S. perspective, 8.5% total inflation. Even if you exclude the highly volatile food and energy sector, it's still 6.5%. So it's an environment that we have not seen in the U.S. since the 1980s.
And in Canada, we go even further back. We go back to the 70s, and we're still talking about what we talked last time, stagflation.
Yeah, well, inflation is not as high as in the U.S., but it is above the unemployment rate, which is the blue line on this chart, and it's a phenomenon that we haven't seen since the 1970s, when Gerald Bowie was the governor of the Bank of Canada. So you mentioned the big word, Martin, stagflation. I think we're still in the inflation part of stag. We haven't seen the stagnation at this point in time, but clearly unusual times, which means that central banks are behind the curve in terms of controlling inflation. So they're accelerating their rate hikes, moving with 50 basis points increments as opposed to 25 basis points. Martin, I don't think they're years behind the curve. It's not the 1970s, but clearly they have a few months of catch-up to do. So they'll be moving more aggressively in the next couple of months in both Canada and the U.S., and I think globally, by the way.
And Stéfane, the market is also doing part of the job with long-term rates, right?
Yeah, and it's a good point, Martin. We have to be careful now. We're expecting central banks to move aggressively. The market is expecting that. But at the same time, you need to control for the fact that market rates or long-term interest rates, government rates, are also moving higher. And you can see on this slide, Martin, that everywhere around the world, rates are higher because central banks also have the ability to use their balance sheet in order to impact interest rates, mortgage rates, which are driven by treasury yields as opposed to short-term rates. So I think this phenomena will help the banks cool the inflation boogie faster than just using short-term rates. So there's both long-term and short-term rates that are rising at this point in time.
And one of the collateral damage of this is, of course, price-earning ratios, and they're being impacted.
Yeah, well, historically, Martin, when you see long-term rates moving up, I mean, a stock market has to adjust the valuations, and what you're seeing right now is even though profits have still been growing globally since the start of the year, the equity indices are down because of compression in PE ratios, and the price-earning ratios need to adjust to this new reality, Martin. Having said this, I think we're getting closer. Maybe there's a summit or peak in sight for long-term rates as we approach 3% on 10-year Treasury yields. So I think that this should help or limit the downfall for equity markets or PE compression going forward. And for equity indices, it means that it's all about earnings going forward.
And the impact of this is, of course, a bit of a pullback short-term in some equity indices, except for a few countries.
Yeah, so PE compression has explained much of the decline in equity markets year to date, which is down 6.8%. As you mentioned, a couple regions are parting ways with the rest of the world. Canada in Latin America. What's the key characteristics of those two regions, Martin? Producers of commodities, commodity producers, so therefore that limits your downside. And we've said before, Canada would be a good place to hide if you're concerned about higher yields in a context where commodity prices are higher, and that is proven to be the case.
We've also talked about the price of commodity, Stéfane. We're reaching very interesting levels. Is it sustainable?
It's a great question. So we know that the Canadian index is doing well, has done well, and you can see that commodity prices adjusted for inflation, the red line on this chart, is at a level that has not been sustained for a long period in the past, except for the 1970s, Martin. I would argue that this time around, it is a possibility that we're going to be enjoying higher commodity prices for longer in Canada, given the fact that we have this Ukraine and Russian situation, the war there, that is impacting two big commodity producers. So to the extent that their supply will not be coming online for globally, that means that Canadian commodity producers are likely to enjoy these higher prices for longer. And I think that will be constructive for the Canadian economy, by the way.
And what's happening with expectation of profitability?
Yeah, we're already seeing globally, earnings expectation for the coming year, 9% expectations. But look at Canada, 12.3%, outpacing every other regions in the world. So to the extent that we're right with our scenario where commodity prices stay elevated for longer, I think that profits will remain strong in Canada. I'm not so sure that the rest of the world will not see downside earnings revision, but for Canada, from a relative performance, I think we will continue to do well relative to other regions.
So that was the good news. Now the bad news is revisions are going down.
Yeah, revision, not the case for Canada, by the way, but globally, diffusion, there's a greater number of companies that are revising down their earnings expectations for the next year as opposed to revising up. So that, Martin, suggests that, yes, there's probably a deceleration in economic growth that is to be expected in the second half of this year. So, and that's partly explains why global equities are not doing as good as what you're seeing in Canada at this point in time.
And let's talk about two topics that are really in the mainstream media these days. First of all, food prices, Stéfane. We're seeing a lot of alarming signs.
Yeah, so among the regions that are seeing downward earnings revisions, Europe, because they're most exposed to Ukraine and Russia and global supply chain, but there's also emerging markets. And the key concern or threat for emerging markets is this rising price of food. And as you know, Martin, in a society where food prices or energy prices increase, the less well-off are more negatively impacted. So if you take that from a global standpoint, emerging markets are less well-off, less wealthy, and therefore are likely to be more negatively impacted by higher food and energy prices if they are not producers of food and energy. So that's why the global deceleration in earnings revisions is primarily a situation that we're seeing now in Europe, but also emerging markets. And that should cool global demand in the coming months and help this inflation deceleration scenario that we spoke to.
And the second very popular topic is the COVID situation in China and hard lockdowns.
Yeah, as if things were not complicated enough, China maintains its zero COVID policy, so shutting down huge segments of its economy, think Shanghai, 25 million people, and we're already seeing a contraction in economic activity in both the manufacturing and service sector in China. So all in all, Martin, this suggests that COVID is not behind us yet. It will continue to impact the global supply chain and impact economic growth in the coming months. So again, deceleration, I think, is the key word here. Not contraction, except for China, but deceleration elsewhere.
Excellent. So I think in conclusion, we can say that the global picture is not super constructive, except for Canada. We remain defensive, Stéfane. We're not talking about recession, but definitely a slowdown. And interest rates?
Slightly higher, Martin, but maybe not as high as what the markets are expecting right now. Our view, again, is that long-term rates, mortgage yields will cool down the economy. So to the extent that, central banks are able to adjust to the supply shock coming from China now and higher food and energy prices, I think that we will avoid recession. But it's just a matter of perspective and amplitude of rate hikes in the coming months. So again, another 100 basis points is coming soon. But after that, I think the central banks will be a little bit more patient.
Excellent. Thank you, Stéfane. Thank you for listening. Let's stay prudent, and we'll see you in a month. Take care.